One shift I made is I shifted to the debt side of real estate, where I started a debt fund and we raised a bunch of money to buy real estate debt instead of buying the real estate itself. We were buying real estate debt that was originated for the purpose of like fix and flip loans, short-term bridge loans that were made to small multifamily investors, that sort of stuff. Just as a bit of a different strategy because it's high current income and it's a lot lower on the risk scale.
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randall. Let's dive in.
Hey, Brian, welcome to the show. It is good to have you. I'm looking forward to the conversation and just chatting with you because you have such a wealth of experience. I feel like we're all going to learn something today. So thanks again for jumping on.
It's great to be here. Thanks for asking me.
Why don't we start with, again, you have a bunch of different asset classes that you've gone through. Maybe just high level, the iteration over time, like how you went from, did you start in single family and then you progressed, or you one of the guys that just started syndicating and you're buying all these big apartment complexes from the jump? Like how'd you get going?
Yeah, I'm a recovering house flipper. So I came all the way up through the ranks of, starting out with buying, fixing and flipping single family homes. And then bought a lot of houses as rentals and built a pretty broad rental portfolio right after the market collapse of 2009, which turned out to be some pretty good timing. And then, kind of grew into multifamily as a natural progression of my single family business, and started out with smaller multifamily and then grew to larger and larger and larger. Yeah. And like every property I bought was bigger than the last one, kind of thing. So I'm an organic grower into the multifamily business, and not one of those that just landed into the business having no experience, which I think personally is a recipe for disaster.
For sure. Yes, I agree. And so, I mean, you started buying in 2009 in a heavy way for the rental side. Is that what I heard you say?
I did, which that's when I really got my house flipping business really took off. I started out house flipping in 1989, if you can believe it. But by 2009, I went from, a business that was doing, 20 houses a year kind of stuff to doing over 100 houses a year and almost a flip of a light switch, because after the 2009 great financial collapse and all the foreclosures, that was kind of my specialty, was buying distressed property and foreclosures. So we were drinking from a fire hose for about 5 years. And when the market bottomed in like 2010, I think it was around 10 or 11, is really when we started kind of looking at the rental as the next progression of the strategy, because values had fallen so far. In 2010, I was buying houses where if I went and researched the title on some of the houses we bought, I found that the prices we were paying were sometimes lower than the prices the houses had sold for in the 1980s. So having kind of turned the clock back 30 years on house prices, I thought this is a really good time to hold some of these. So we collected about 120 of them in the San Francisco Bay Area, right there at the bottom pricing, with the thesis that the prices were going to double in 5 years. And of course, everybody said we were crazy and it's the wrong time and we're catching a falling knife. I heard all those excuses. But 5 years later, it turned out I was wrong. The houses didn't double in value. They doubled in a half.
Yeah, I was going to say.
It turned out to be a really good trade.
That's wild. So that's when I started buying houses, was 2009, and buying houses in San Antonio for like $20,000. So what was the price point? And we don't have to dwell on the single family side too much, but what was the price point that they were trading at in 9 and 10 when you started picking them up?
We were buying stuff for anywhere between, 100 and 250, okay. In a market where, before the collapse, you're talking 200 to 500. So it was substantially lower than, just a couple of years prior.
Yeah. I've noticed lately, I mean, I was on MLS today just looking, and a lot of the big names, at least in this market, that were listing all of the foreclosures, they're popping up again. Like I've seen a number. I don't know if you're seeing any of that in your market or not, but if you're not doing the single family side as much, then you probably wouldn't be seeing that. But it was just interesting to see that. So, all right. So you were doing that when you're working on that many projects and properties, you have to build a team. I imagine you had contractors. I mean, that's a lot of moving parts and a lot of things going all over the place. Um, how on the finance side, how were you structuring that? And was that your initial foray into raising capital, or had you already been raising capital on deals prior to that, prior to doing that many deals?
I'd already been raising capital prior to that for my house flipping business just to kick it started the way that I did. Because when I started in this business, I had nothing. I had no money, no contacts, no knowledge, no nothing. And after several years of, basically kicking and scratching my way into whatever deals I could get into, I decided it was time to raise some money from investors. And, the first time I raised money from investors, I raised $500,000 in $5,000 increments from coworkers and friends. And it was really kind of doing it the hard way. And that was for the house flipping business. But when the foreclosure stuff came around, things really accelerated quickly. And then I was forced to a position to raise a lot more money a lot faster. And so that's when I started raising money for that side of the business. And we got a lot of investors, that were following us. We got a lot of like press coverage and that kind of stuff, which caused people to come to us wanting to get involved in what we were doing. And after a time, I started to notice that we'd built this huge following of investors, yet the foreclosure crisis was only going to last a few years. And it's like, what are we going to do after that? When the foreclosures are gone and there's no houses to flip, I've got this great base of investors that want to place money somewhere and I'd have no place for them. And that's when I decided that I really needed to place more emphasis on the multifamily side. I'd already had been doing multi for a while, but on a much smaller scale, like with smaller multi, doing my own, a couple small syndication raises from friends and family for, mid-sized buildings like 50, 60 units, that type of thing. But it was really time to grow and scale. And that's when I started making that effort and raising money for, 100, 200, 300 unit buildings.
Nice. So when was that when you first started taking on like 150 plus unit?
What's that? Yeah, I think our first one was around 2011 or so, okay. 2011 or 12, I think was our first larger one. My first multifamily was in 2002. So I've been doing this for about 22 years, but it was about 12 or 13 years ago that we really stepped up our game into much larger properties.
Yeah. Got it. Okay. Well, let's fast forward a little bit then, because all right, so you're moving into the multifamily, and again, just from looking on the research that I did, you've got still the single family flips going, you've got single family rentals going, you've got the multifamily. Looks like you have a fund dedicated to rebuilding. Is that a fund that you guys are doing real estate wise, or is that some other kind of fund that you guys are working?
Yeah, that one's another single family fund where our city was halfway burned to the ground in a wildfire a number of years ago, and 5,300 houses were burned down. And so that fund is dedicated to acquiring lots from owners that didn't want to rebuild and building spec homes on them. And we've done a few dozen spec builds. That's winding down, getting close to the end on that one. So we won't be seeing much more of that opportunity because we're almost all built back. So which is a good thing.
Yeah, for sure. For sure. Well, so again, going through that, one thing that I noticed is that you sold off 75%. It sounded like in an interview you gave 75% of your multifamily assets in 20 and 21. Is that accurate?
I did. Yeah. I saw something coming. I wasn't sure exactly what it was, but I could tell that something was coming and it was a really good time to get out. So started selling in 2021 and finished selling early 22. We got 3/4 of our portfolio sold, and then the market just fell off a cliff. So timing wise, it actually worked out pretty good. I wish I could have sold everything. Yeah. That would have been nice, but it didn't quite work out that way. But I'm still glad I don't own everything.
Yeah. I mean, that was the question. Like, what was the indicator or indicators that you were looking at to give you that? It sounds like you said it was a gut feel, but bet there was more to it. What what was it that was it just the pricing? I mean, the pricing was through the roof. And so
Yeah. Pricing
yeah,
was through the roof, but more than pricing, sentiment was through the roof.
yeah,
And so what I started to notice is that we got into this thing where I would kind of jokingly call it the everybody wants to be a syndicator phase of the market, where, literally people with zero experience are buying $50 million apartment buildings with all investor money. And the investors had no idea what they were getting themselves into or how inexperienced the sponsor was and that sort of stuff. And they were bidding prices to the moon. And we first noticed this because as a buyer, we were getting outbid by groups like, well, who are these people? Where do they come from? And why are they paying, $3 million more than we would be willing to pay? And why are they outbidding the highest bidder by $1 million? None of that made any sense. And oh, by the way, they're putting up $1 million non-refundable earnest money deposit at contract signing. So, you start to see that kind of thing happen. You're like, if that's what's really going on out there, we should probably sell some of our stuff to some of these guys.
yeah,
So we got an unsolicited offer on one of our properties, and it was like way more than we ever could have imagined getting. So we're like, if you want it that bad, it's yours. So we signed that deal, got that one sold, and then it got us to thinking, well, why don't we try selling some more stuff and see what happens? And we did. So we put things on the market, and we'd get 20, 25 offers, and way up over our whisper price with non-refundable 7-figure earnest money deposits at contract signing. And we just kept it going. And we kept doing that and kept doing that and kept doing that until finally we had a property fall out of escrow because the market had started to turn and, the buyer couldn't get his financing and we knew the party was over. And it's like, all right, now we have to shift into hold mode and just wait this out.
yeah. So you weren't acquiring. When did you stop acquiring, or were you still buying in 20 and 21?
We bought our last property in 21, and I think we bought one or two in 2020, and that was it. And we haven't bought anything since.
Yeah. Interesting. So if you aren't, and you're just sitting in, I guess not sitting, but you're operating what you have, right? Have you shifted investing into other asset classes?
Not real estate asset classes, because I've done that already in the past, and I found that every time I ventured, too far out of my lane, it didn't always work out the best for me. I mean, thank God I've been doing this for multiple decades. I've never lost a dime of investor principal, so that I've got going for me. But I also didn't make myself any money doing some of these other strategies. So I decided that this time around, I'm not going to do that and venture off and start doing office buildings or, any of that kind of stuff. Instead, I made a couple of different shifts. One shift I made is I shifted to the debt side of real estate, where I started a debt fund and we raised a bunch of money to buy real estate debt instead of buying the real estate itself. We were buying real estate debt that was originated for the purpose of like fix and flip loans, short-term bridge loans that were made to small multifamily investors, that sort of stuff. Just as a bit of a different strategy because it's high current income and it's a lot lower on the risk scale. So that was the one shift we made. And the other shift I made just on a more personal level is I just started allocating more of my resources to things outside of real estate, such as just your typical run-of-the-mill stocks to private placements in biotech, pharmaceuticals, agriculture, oil and gas. Really kind of shifted my personal investment portfolio to alternatives outside of real estate for a while. And I think that'll end up shifting back. I think real estate's going to bottom out here sometime in the not too distant future. And, I'll be right back to getting after it again.
All right. Well, let's pull on that thread then, because like we were talking about a minute ago, it's a, maybe I was talking to somebody else about this, but it's alternative assets in general and what the return profiles are for different types of asset classes and investments. Of the things, obviously you have the real estate experience and now you're the LP going into these other offerings. What are you most excited about from the myriad of things you've invested in? Again, this is for educational purpose for me, for anyone else who may be looking at alternative assets or alternative investments rather than sticking everything to real estate. Like what do you like the most, and what's giving you the best returns for the lowest risk right now?
Well, I think when you start in any kind of a new strategy, you feel like a kid in a candy store where everything looks great. And then when you get seasoned and soured, you start to realize that, everything's just another threat. So I'm still a little on the newer side on some of these other alternatives. So I think everything I invested in is great, or I probably wouldn't have invested in it at all. But history will be the guide, and I won't have that hindsight until it's all said and done. But everything that I'm investing, in on the alternative side is a little bit what I would call higher risk for my typical risk profile. Any time you're in with a startup, pharmaceutical, or, inventing a new drug, a new agricultural technology, these things may take off and they may not take off. I really do like the oil and gas opportunities. I think it's a little bit less risk than some of the other more startup investments that I've been in. So, I'm trying to balance. I've got quite a balance of risk. And I think that's the best way for me to do it, where I don't say like, well, this is going to have the highest return, so I'm going to put all my resources there. Rather, it's more of a little bit of a focused, diversified approach, where I've picked like the theses that I believe the most in, and I've made sure that there's several of them so that if one of them fails, it's not going to injure me too badly. And I've mixed that in with stuff that is a little bit more plain vanilla, that's maybe not going to be really super high return, but is a little bit lower risk and maybe more consistent cash flow. So I've tried to build a portfolio around, thinking about, aggressive growth balanced with current income and lower risk stuff, and trying to have all of that.
Okay. So what is the, I like pharma, and those types of investments I can see could be more on the risk side, but what's providing current cash flows? What type, is it oil and gas stuff?
Yeah, the oil and gas is the highest current cash flow that I have. And then the next one I have is I've invested in a company that does some trade finance, which is kind of a way of doing business debt, but their approach is a really creative way of doing business debt, which is it's a high yield yet lower risk strategy, which is kind of really interesting and unique. So those are the two things that I found right now providing the most current cash flow. Of course, all the startup stuff, not so much.
Yeah. All right. So then let's, again, same with multifamily, same with syndicators, a lot of guys coming in and not having the experience, and a lot of LPs giving them money and then finding out later. Right. So we talk about, and I know you talk about like vetting a sponsor, and how to find sponsors and that sort of thing. How did you go about finding operators in each of these fields? What is some parallels maybe with the multifamily side or with the syndication side in real estate for the investments that you were looking at?
Well, I took the easy way out. Is I have a family office that
I was gonna ask that too, yeah.
that does that for me and will bring me opportunities to look at and make decisions on my own whether or not I want to participate in them. And they have a lot of exposure to really unique opportunities through their many years of relationships in the fund space and so on. So they see a lot of things that I never would have had the visibility to see. And that's something that, for many years I struggled with, like, why would I ever hire a financial advisor? I'm going to literally hire somebody that's making $75,000 a year to make decisions on my portfolio. And it's like, okay, I blew past them, a long time ago. And so I resisted for a long time. And then I came to learn there's some really smart financial advisors out there, and you just gotta find them, I think. And the funny thing in this case is sometimes they find you. And that's, I think, more of what happened in this case is just kind of, one relationship led to another relationship that led to another relationship. And eventually you're like, okay, you really know what you're talking about. And I'm going to start listening to what you say when you bring me opportunities.
Yeah.
And that's really how it plays out.
Interesting. Yeah. So, all right, let's get back into the real estate side of things then. So if are you guys pencils down right now? Are you guys not looking for new opportunity? Are you guys doing any more of the failed developments and that sort of thing? Are you got like where are you, I guess, right now in the market?
I'm really not much in the market. We've been pencils down for about a little over 3 years,
Yeah.
almost coming up on 4, but I'm starting to like sharpen the pencil. And we're looking at some deals now, and we've looked at some occasionally throughout this entire period because we wanted to stay involved enough in the market to have a sense of where the market is and where it's going. I mean, if you completely ignore it, things will happen and you'll never see it coming.
Yep.
So we've always stayed involved where we're looking, but we're just been way off. There's a huge buyer seller disparity. We haven't been able to reconcile it. And so we kind of gave up trying, and we just underwrite for the fun of it, just to kind of see where things are trending. I am noticing now things seem to be trending more in line with where they begin to make sense. We've been, getting relatively close on deals. And by relatively close, I mean, maybe we're only 10% apart instead of 30% apart. So there's progress. We're looking at one now where, we might get close on it, and who knows, maybe not. I guess we'll see. It's just a matter of time. I mean, there's more distress enters the market. It creates more opportunity on the buy side, and that's just only now beginning to happen.
Yeah. Is the debt fund structured for all real estate? It's all real estate debt fund?
It's all real estate debt. Yeah. So everything we're doing is, fix and flip single family, fix and flip small multifamily. We did some ground up construction. I don't think we have any ground up construction in our portfolio currently. But it's all on the residential only side. It could be commercial residential, but it has to be residential. We don't do office buildings, industrial parks, any of that sort of stuff.
Do you have any portion of that is like pref equity on a capital stack for the multifamily side, or is it really you're going in taking over the first position?
Yeah, we're first position lien holders. Yeah, we don't have any pref equity spots.
Yeah. And what is check size you guys like writing on those deals?
I think our average loan size is, I don't know, like 600,000 or 700,000, but we have deals as small as 100,000 and as large as 4 or 5 million.
Yeah.
So it's a little bit all over the board.
Yeah. Do you guys focus mainly in one market, or are you guys all over the US?
We're all over the place. I think the majority of our loans just happen to be in California, Oregon, and Washington, but we have loans in several other states across the U.S.
Yeah. Nice. All right. From an investor point of view, then, for the debt fund, then is it something you can talk about, or is it a closed?
Yeah, I can talk about it. Our investors are basically getting a preferred return and then a split of the profits above a preferred return. So the interesting thing about this from an investor standpoint is, the structure of it's relatively familiar already if they've invested in equity offerings. The difference is that, we're investing into a lower section of the capital stack than if you're making an investment that's acquiring the real estate. When you acquire the real estate, your money is in first loss position. When you're investing in this debt fund, your money's in second loss position because the owner is in first loss position. So it's a different risk profile. And I think the other thing, that's one of the reasons why I did it, is I felt like our investors are really going to enjoy having, a lower risk alternative where they don't have so much principal exposure based on market movements. The other reason I did it is because it just seems like people really are looking for current cash flow. It's a real priority. It used to be everybody was focused on appreciation. But then appreciation all of a sudden vanished. So people realize the value of current cash flow. And when you acquire like a value add multifamily, for example, your cash flow could take a year or two to really ramp up to anything meaningful. Oftentimes, first year cash flows are 2 to 3% if you're lucky. Second year, it's 3 to 4, and it's like year 4 or 5 or 6, you start to get into the high single digits. And the thing I like about on the debt fund side is that high single digit cash flow literally is day one. I mean, like prorated to the day you made your investment, we're making distributions in high single digits day one, and that's just something you don't get on the equity side. And you're giving up the upside, which you have when you buy, like invest in a multifamily fund, for example, but you're exchanging that for immediate current cash flow. And I just think that's appropriate for the time that we're in. In a year or two from now, maybe not so much.
Are you guys still raising for that? It's just an open-ended fund where you guys are, when you need capital, you call capital, or how does that set up?
Yeah, right now we're buying loans as fast as we can raise capital. So it's we've been raising for it, and who knows how long that'll keep going. It could happen for a considerable amount of time because there's unlike acquiring assets where you got to find something at a really good basis, and you got the numbers got to work and all that kind of stuff. It's hard to find deals, but on the loan side, it's a lot easier to find deals. There's a lot of debt out there, and we're not as concerned with a quote unquote deal. We're more concerned with borrower quality, loan to value ratios. What's the equity cushion? What's the debt yield going in, debt yield going out? How much cash reserves does the borrower have? All those kinds of things, because that's what's standing behind that loan.
Yeah. Is there so if you're buying the debt and you're buying the note that's already been created, are you guys getting significant discounts typically on that, or is it are they seasons enough and you guys are paying like face value for the note, or are you guys just creating the debt from? Like, if it's a rehab loan, then you guys are, I guess, creating the loan.
Yeah, we buy at par. The loans that we're buying are 10.5, 11%. They're short-term bridge, fix and flip type loans, what you've seen out in the private money marketplace. So, we don't have to buy at a discount. These aren't distressed, non-performing loans. These are performing loans. So, we don't have to try to chase down discounts.
Got it. Yeah. Interesting. So, I mean, we've talked about a number of things here. It's kind of all over just because, again, you've done a lot of things. And I'm just kind of curious. So in the next, 12 months, you guys are just buying as much debt as you can. What does your team look like right now? If you guys aren't buying multifamily, did you guys pivot the team, or did you just still have people underwriting for the fun of it? I like how you said that. Like we're just kind of,
yeah,
Hey, Jim Bob, go over there. Look at that deal.
Yeah, right.
Work, but
yeah, that's kind of how it's been. We've our debt team is completely separate from our multifamily asset team. The only thing we share there is investor relations, because we're raising the money for it, and then we've got a team that specializes on the debt side. On the multi side, we never grew that team. We did a lot of transactions and a lot of business and had a large portfolio with a very small head count. So we didn't have to change our head count when we stopped acquiring. We've only got, just a handful of people, 5 or 6 people. So that was the good thing. We did, of course, have to trim operationally. We had 50 employees on the management company side, but as you sell properties, most of that is property staff. They tend to stay with the property and get hired by the new buyer's management company. So, we didn't see a lot of layoffs and job loss. It was just our operational team shrunk as we sold the assets off. So we've had a pretty easy time of, having the kind of that rubber band effect where you can shrink and grow without causing too much damage.
Yeah, nice. What kind of software did you guys create? Because that's something that we were looking at and said you created a proprietary software to help you with the acquisitions. So is that on the single family, multifamily? Like what asset class was that in?
Both, actually. I first created my own software package on the single family side because I was buying foreclosed houses on the courthouse steps, and I needed a way to track foreclosure auctions because they frequently get postponed. I needed a way to gather all the title research because you don't get a title report and title insurance. You know, you buy whatever title the lender had, and you better know what that looks like. And so you have to be able to keep track of all those things. Houses will go to auction on a moment's notice. So, you know, you have to prepare in advance by looking at the houses. So assessing the condition of the property, you know, the roof, windows, landscaping, paint, you know, all the things that you can see from the outside because you don't get on the inside. You know, what's the rehab budget? What's it going to cost? And keeping track of all that data and having it accessible when it's auction time to be able to set bidding limits is crucial. So that was the first software package I wrote, was something to help us deal with that massive amount of information. And that became invaluable, by the way, when we were chasing 300 houses a day at the peak of the foreclosure crisis several years ago. On the multifamily side, I wrote my own underwriting model where, you know, we can gather all the financial data for the property, historical data, make future projections, insert a variety of financing alternatives, a bunch of different capital structure options like preferred equity or not, and assumable loans or not, new loans, you know, and underwriting the loan sizing, how much, what's the, you know, debt service coverage constraint that might limit our loan proceeds, where's that going to land, and then being able to give forecasted data to the investors for our pitch decks. You know, you've got to have a really good, solid financial model to show that future income and calculate future exit prices, what the waterfall is going to look like, basically follow the cash flow all the way from the rent check all the way to the investor distribution. And on the asset side, you know, the acquisition all the way through to the disposition, and being able to track all of those things. So it became a very complicated and complex model, but I think it gives us a tremendous competitive advantage.
Yeah. So you don't sell that? It's not a packaged and SaaS
I
stuff?
don't. I
No?
don't. I don't want to be in the software business and
Yeah.
software support. Now I'm taking calls from like,
Yeah.
well, you know, this is my scenario. What cell do I fill in? You know, that's not the business I want to be in. I'm in the business of acquiring real estate, and I think, you know, it's an incredible exercise. And you know, I'll tell anybody that wants to really get into this business and raise investor money is you're going to get a lot of questions from investors, you know, about how the finances work and that sort of thing. And I'll tell you what, there is no better way to understand every element of how this all works than to have to create your own model. I mean, you know, if somebody has a question about how one number relates to another, I have the answer. And it's amazing to me how oftentimes sponsors will be like, well, I'm not really sure. You know, it's like, I don't really know how I got at that number. I put it in the model and it spit this out. You know,
Yeah.
it's like, okay, well, how does it arrive at that?
Yeah.
You know, understanding all those calculations, understanding how to do a waterfall, and, you know, to the extent where you could literally calculate it by hand. That's the level of understanding I think you have to be really successful in this business. And I think the only way to really get that level of understanding is to write your own software model.
Yeah. No, that's great advice. I remember taking classes and creating our own models, and how much more involved you get and know what is happening in those things. I was going to ask, do you have a finance background, or you just picked it up as you went, as you were buying and as you were, what's that?
I'm all self-taught.
Yeah.
I've got a PhD from the School of Hard Knocks.
Nice. Well, Brian, look, man, I think we can wrap it on that. I appreciate you jumping on. It's all the things that you're working on. You got a ton of stuff going on. I'm hopeful for at least on the multifamily side. I hope that bid ask starts to compress and get to a point to be personally, because I want to be buying some things. And if you are still raising for your debt fund, then by all means, I want to you know, invite people to reach out to you directly and your team so that you guys can have that conversation if you guys are still raising for that thing. So again, thanks for jumping on, sharing your knowledge, talking about your business and what you got going on.
My pleasure to be here. Thanks for having me.
Yeah, for sure. Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.